Okay, let me try and record the session for those who won't be there. Right. The issue is we believe in the market maker cycle, and this is how the cycle looks like. So what we are simply saying is we believe that the market has to trap people before it moves in a certain direction. So the market cannot move in an intended direction before it traps a certain group of people. So now the question is, why do we have these double tops, double bottoms in the market? I know maybe most of you might be asking themselves, why do we have these double tops and double bottoms in the market? Now, this is what the market maker does. So I'm going to be using a W and I'm going to be using an M, whichever way, it means the same thing. So these M's and W's, the market maker uses them to trap people. So what it does is, let's say the market is moving in that direction, short. So it means that we will be having people who will enter their trades going short in that direction. So what the market does is when it gets at this point, the market makes sure that it changes its direction and takes out everyone who went short right here. So once the market does that, what happens is those who went short, when they are taken out, the market induces traders to go long. The market induces traders to go long. So as they go long, the market then decides to turn around, because the key issue here is about trapping traders. So when the market turns around and goes back in that downward direction, I want you to understand this. We get more sellers, even those who were taken out here will come and re-enter there with bigger lots, bigger positions, so many positions. They will enter with confidence. Why? Because there are some people that when they are taken out in the first move, when they see the second move, they believe it. Why? Because they believe something when they see it the second time. It's like a simple example. If you want to believe something, if someone says, I saw something happening in America, and you don't believe it, but when you see it happening here in Zimbabwe, everyone starts to believe it. Why? Because they are seeing it the second time. Right now, everyone believes that there is coronavirus, but we haven't seen it, we haven't felt it, but we believe. Why? Because we are seeing numbers from different areas. So some people believe something when they see it the second time. So this is what they do. When they see something the second time, they enter aggressively because they were taken out the first time. So the market will now be having more sellers. The market will now be having more sellers. So in that fact, we will be having less buyers. We will be having less buyers. So once we get in here with a buy, the market will decide to go in the direction where there is less loss. I want you to get this right. The market will always go in the direction where there is less loss. So that is exactly how the dealer traps traders and leaves people trapped. So I'm going to repeat this one more time. We are saying that this is our market maker cycle. So we are saying these M's and W's, the reason why they appear in the market is because they are used as trapping activity in the market. They are used as trapping activity in the market. So what happens is the dealer will induce long, and then the dealer will take out everyone who went long. By so doing, then the dealer will induce short at the same time. So after inducing short, he will take out everyone who went short. Then those who went long right here will enter aggressively here, and the dealer will trap times 2 buyers and then be left with very few sellers and go in this direction. Now, when the dealer is going this direction, remember there are some people who believe something when they see it moving. So they will start adding their sell positions. When the dealer gets to this point, he will induce long again. There are some people who were taken out the first time here. They were taken out and trapped the second time here. They see this happening the third time and they are like, let's add positions so that the positions that we are going to add here, they are going to cover the loss of the positions that are trapped here. And what does the market maker do? He shifts the zone and moves away from them. So he leaves them trapped. Let me tell you something, guys. Every time when you press a buy or a sell in a pair, every time when you press a buy or a sell in a pair, always know that there are 10,000 of you that are thinking the very same thing in that very same area. Always know that. The market maker, when he comes for your stop losses, don't think that he is targeting your account or he knows that you are a trader, he knows your address where you live. No, the market maker knows where every one of us places their stop losses. He knows the positions of those stop losses. So when he comes there, he knows that I have so and so at that level and they've placed their positions. He will come and grab them and go away. Someone came to me last week and he was like, my stop loss was hit, but I never saw candles going there. And I said to him, no, the issue that happened was the market maker, he went close to that area and he opened the spread, grabbed your stop loss, and then he moved away. So that is exactly what the market maker does. So after, when we get to this position, the market maker, remember we have buyers, we have sellers getting in along the way, and we have people who have been trapped almost this whole part of the trade, and now sellers are getting in. The market maker has to clear the board of those sellers again. So these pullbacks are used to clear the board of sellers. So the market maker clears the board of those sellers, and then what the market maker does now, he will make sure, the market maker will make sure that whilst he is taking out the sellers, he induces people to go long. And after that, the market maker will pull away again for the third time. And remember, I said there are people who believe something when they see it the second time or when they see it the third time. So what the market maker does, now that there are people who saw this the first time, they saw this the second time, some of the newbies or some traders will enter aggressive here. Why? Because they believe that when a trend goes in one direction, they now say it's now a mature trend. We are now looking for short positions for a very long time. What does the market maker does? He comes here, he traps people the same way he trapped them at the top, and he shifts the zone and go away. So this is exactly how the market maker's method work. I'm going to share with you even the examples from the charts to show you exactly how it comes out. But before we go to that, we're going to do some labeling. We're going to do some labeling for some terms so that at least even if I send a setup in your WhatsApp group, you will know what I'm talking about. All right. You will know what I'm talking about. Now, someone may ask, where do we see this cycle? I'm going to be frank with you. The time frame we use is H1. However, this cycle appears on all time frames. This cycle appears on all time frames, but we normally use H1. Why? Because most of us traders, we are normally day traders. We trade on a single day and we are out. We take our 50 pips, 20 pips, 30 pips. That's who we are, most of us traders. So there is no point in you looking for this cycle in a 1 week time frame when you know that you are just an intraday trader or a day trader. So most of us, we are day traders. That's the reason why we largely look at 1 hour time frame. So get me right, I never said that this cycle appears only at 1 hour time frame. And it is very clear on 1 hour time frame. So now, Here is what happens, guys. Here is what happens. I've shown you how the market trips us. So now I'm going to do the labeling. This M here, they sometimes call it the HOD. HOD standing for high of the day. They sometimes call it the HOW. HOW standing for high of the week. They sometimes call it HOM. HOM standing for the high of the month. That's why sometimes you hear me saying, we have caught the high of the month, we are now trading away from that month. This is what exactly I'll be talking about. I'll be talking about the same cycle, but in a different time frame now. They sometimes call it the peak formation high. They sometimes call it the HOD, I've spoken about it. They sometimes call it the M formation. Some, they call it the double top. So there are so many ways, there are so many names to this. Now, this one right here is the opposite of that. LOW, low of the week, low of the month, LOD, low of the day, LOW, I've spoken about it, peak formation low, and sometimes they call it the double bottom. They call it the double bottom. So there are so many ways and there are so many names, and they all depend with where you are in the market. They all depend with where you are in the market. So guys, these right here at the center, they are called pullbacks. They are called pullbacks. The other name we use, we call them stop hands. The other name we use, we call them stop hands. So I'm going to be talking mostly in layman terms so that at least all of you can understand what I'm talking about. Now, you have probably heard about levels, that there is level 3, level 1, level 2, and all those things, and they are so confusing to you. Let me make it this simple to you today. Every peak formation happens on level 3. Every peak formation happens on level 3. So it means whatever is in between is level 1 and level 2. All peak formations happen in level 3. So it means whatever is in between is level 1 and level 2. And probably some of you might have heard about this thing called MVV, MAAW, WVVM. Maybe some of you have heard about that. What they are simply saying is they are saying this is our M, this is our A, this is our A, this is our W. So meaning if this cycle is gonna continue this way, then this becomes our W, this becomes our V, this becomes our V, this becomes our M. So now for us to simplify BTMM, we are then saying level 3, level 1, level 2, level 3, right there. Then we put our W there, we put our V there, our V there, our M there. We put our M there, our A there, our A right there, and our W there. So now you know that anything that has to do with a peak formation, it should be an M, a W, level 3. So it means that if we see an M or a W, we can't talk about this. These are the peak formations that I'm talking about. Whether you're on M15 or you're in H1, if we talk about an M or a W, remember we are talking about level 3. If we are talking about a V and an A, remember we're talking about a 1 and 2. So the V and the A are these pullbacks right here. Now, these moves are then what we call the ADR moves. These moves are what we call the ADR moves. What we simply mean is that the dealer cannot move the market in a single direction for a very, very long time. The dealer cannot move the market in a single direction for a very, very long time. So the dealer has to move the market in levels. The dealer has to move the market in levels. And I want to be frank with you, this also applies even in indices. It's so clear, you can see it even in indices. The only thing you need to do is to apply your knowledge. Any strategy that you know works everywhere. Any strategy of the market that you know works everywhere. The only thing you need to do is to take the knowledge and apply it there. Right. Rules can be different, but strategies work everywhere. I always hear some people say, I have a strategy for gold, I have a strategy for Euro USD, I have a strategy for what and what. And I'm saying, I don't have a problem with that, but be a master of one strategy and you will be a master of everything. Or master one strategy and you will be a master of everything. So guys, now this is very simple. I've simplified MMM for you. If anyone comes and tells you everything that is different from this, I'll be frank with you, they will be lying to you. This is MMM in simplicity. Yes, there is deeper knowledge to it. There are a whole lot of things that you can learn, but this is MMM in simplicity. Now, I would want us to shift over to our charts and we see if ever what I'm saying is true. So for today, we are going to use currency charts, but I want you to know that it's the same thing everywhere. It's the same thing everywhere. Now I'm going to share my screen to my chart so that we take a look and we see if ever what we are talking about is real or we are lying to ourselves. Right. All right. Otherwise, Arthur, is my audio okay? Arthur, confirm my audio is okay. All right. So guys, here is a chart right here. You want to know where you are. And remember, we said that where we have peak formations, that's where we find the level 3s, the M's, the W's, etc, etc, etc. So I want you to look at this. Here is a chart right there. If I come here, to me, I am seeing level 3 there. I know some of you don't know how I saw that. Maybe in the next live Zoom meetings, we are going to talk about how do you know where you are. But today, in general, I want to show you that the market maker method does appear from the charts. Now, so this is an M formation. It rallies down, pulls back, rallies down again, pulls back, comes right here, give us a W there, come up, pulls back, comes up, pulls back, comes and gives us an M formation there, comes down, pulls back, comes back down, pulls back, comes down, give us a W there, comes there, pulls back. Can you see that? So that is exactly how you see the market appearing. That is exactly how you see the market appearing. Anyway, I'm just checking the charts page while he's talking, so don't worry if I'll be disrupting you. I'm just seeing the funny comments of people posting about Kinimbi and so forth. Those who want to go and join Kinimbi, please feel free. You can go there and join him. He's also hosting a live session, but we are not stopping for anyone here. So I'm just simply showing you, look at this, how the market can be best predictable using this. Now, the only thing you need to know is where you are in the market. The only thing you need to know is where you are in the market. So I'm going to zoom this chart just a little bit. I'm going to zoom this chart just a little bit so that we go through again what I annotated, right? Remember that M I talked about. Remember the pullback there. Remember that pullback. Then we are down right there. Look at that big M, big W there. Look at the pull there, the pullback. Look at that. Look at that. Then we come back to the M formation. Let me try and pull the chart again so that you can see, right, now the chart looks clear. Now the chart looks clear. All right. I want you to look at this. There is your W there, the pullback. We get to an M, and to me, this is the same level. To me, this is the same level because we keep hitting at the same low. So I just wait for it and leave it. Look at that pullback right there. We go down, look at that pullback right there. Then we get to our W. So you can see that the market moves in a cycle. The market moves in a cycle. So it is up to you now to decide, do you want to trade the cycle, the whole cycle, or you only want to trade on a single day, grab your 20 pips, 50 pips, 30 pips, and then you're out, or you want to move from peak to peak. Remember, I said all strategies work, whether price action, inner circuit trader, ICT, whatever strategy, Elliott waves, etc., they all work. I am just trying to show you the other side of market makers method, because I believe that sometimes it is very good to master one strategy and then have a little bit of some knowledge on other strategies. It also helps you even on confirmation of trades. It also helps you even on confirmation of trades. Now, this was USD JPY. Let me change the pair and go to, maybe this is Euro USD. Change the pair and go to Euro USD. All right, now let's look at Euro USD. There we go. We got our W there. We push up, we pull back, we go up, we pull back, we go to our M formation there, we come down, we pull back, we push down, we pull back, we push to our W right there, we go up, we pull back, we go up, we pull back, we go to our M formation there, though it was an ugly one last week, we come down, we pull back, we come down, and we closed the market with a pullback. So what do we expect? We expect the market to go down. So you can see for yourselves how simple it is. Now, let's try and zoom the chart so that we can all see clearly, so that you won't say this guy is lying to us. Right, I'm gonna zoom the chart there and scroll back where we started. So there are ways in which I see where we are, but then it's just that I'm not going to explain about them today. But there are ways in which I see where we are. You can see that. Let me try and scroll it. Can you see where I ended? Can you see where I ended? This is exactly where we see a new W coming there, right? So it simply means that even if you are at this W, even if you are at this W right there, you are seeing a multi-days W right there. You know that you are expecting the market to at least trend for some days in a certain direction. That's the reason why you see even some of my signals and setups. I tell people that we are expecting a TP of 3 weeks, 4 weeks, 5 days, 15 days. The reason why I give days, it's not that I'm giving you an accurate day where we're gonna, accurate day we're gonna hold the pair. I'm just giving an estimation that this pair has a likelihood of selling for so many days. This pair has a likelihood of going this direction for so many days. Why? Because I'll be seeing that where we are coming from and where we are going to, we can likely take how many days to get there. So that's exactly how different it is. So now, if you see this W appearing there, because you have finished your downward cycle, you know that you are expecting something like this from the market. So let's look, let's scroll again and see what happens. This is what happened last week, and most of my students enjoyed this move. They enjoyed this move. Now take a look at this. There is a W right there. We have our first push, then we have our pullback, we have our second push, we consolidate, we close end the week, we start with a pullback, then we head up, and we give an M formation right there. So you can see that the cycle presents itself all the time. What you need is to be clever enough for you to be able to interpret data and present and see the cycle being presented to you. You can see for yourself right there, and you can see that we have let me explain this that happened here on Friday. The dealer was supposed to stop and high, close, stop onto the 200 EMA, and then trend to the downside. But what the dealer does, he actually went down, and then he created an LOD on that day, and then he went back up. And after going back up, he left the market at a very good position, such that even if you could have opened a trade here on Friday, if you would open at a market gap below right here, you'll be in good profit because he left a very good trade. I saw it on Friday, he left a very good trade. But the market will have to go down before it goes up. So in general, guys, this is exactly how the market makers work. This is exactly how the market makers work. I'm going to open USD Chef, our last example, and show you our last example and show you. We can see this is where we are seeing our level 3, and this is where you are seeing your double top right there, your pullback, you go down to your W, though this is an ugly one, you move up, pullback, then you go to an M formation, pullback, then you go to a W formation. So you can see for yourself, even USD CAD, that is the exact same thing that is supposed to do USD CAD. So this is exactly how the market presents itself all the time. This is exactly how the market presents itself all the time. So guys, right, I'm gonna take at least maybe three questions from you. Nick, you are sleeping. I'm gonna take maybe 3 questions from you. So I'm gonna unmute Mr. Romantic. Then he's gonna maybe give me just 3 questions. If I'm able to answer them, I'm gonna answer them. If I'm not able to answer them, guys, I will tell you that I don't know. I don't know everything, but the little that I know, I've shared with you. This is our day 1. So this is basically everything about MMM. So I'm going to share something after attending to the questions. So we are going to end our meeting at 11 together with the Ginimbis. So guys, I'm going to take 3 questions from Arthur. Then from there, I'm going to tell you something, just a few minutes, and then we end the meeting. So Arthur, you can bring the questions.
I don't know what to ask you.
No, tell me what people are asking. Tell me what they're asking from the chats page.
Oh, from the chats page. Someone is saying, how do you use ADR?
All right.
How do you use it?
All right. How do you use ADR? Right, guys. I'm going to give you a little trick today about ADR. ADR is the average daily range. ADR is the average daily range. If a pair has got 70 pips ADR, it simply means that basically this is the amount of pips at least the dealer is allowed to move in a single day. So we are simply saying that if our market is to move in a cycle like this, maybe from this point to that point, we expect at least around 70 ADR. From that point to that point, we expect at least around 70 ADR. From that point to that point, we expect at least around 70 ADR. So this is the ADR. Now, how do we use ADR? ADR shows us sometimes that that our trend is about to reverse. Maybe, let's say our 3 times ADR, our 3 times ADR is 150 pips. So in other words, we are saying that if a pair moves from here up to there, it should be at least around this figure. We are not saying it should be 150. It should be at least around that figure. It can be more than, it can be less than, but it should be somewhere there around that figure. 130 something, 140 something, 150 something, 160 something, 170 something, 180 something, because the dealer can move so many pips. But then the ADR shows us at least that we are now at 150 ADR. Maybe the market is about to reverse. We are now then expecting an HOD, we are now expecting a peak formation low or a peak formation high. So that is the first use of our ADR. Our second use of ADR, some of our intraday setups, they normally form at ADR range, where you have that ADR high there, you have maybe the ADR low there. You realize that the dealer, what he's going to do, he's going to stop hand up, then gives his setup close to the ADR high or the ADR low, depending with the direction, and then he trends downwards to hit the ADR that is below. Once he hits that ADR, you see him, even if he goes beyond, you see him trading right back into ADR and ending the day in consolidation. So sometimes the ADR, we use it to identify these LOD, HOD patterns. It helps us a lot. Now, another way, which is very interesting, that I would want you to take advantage of this coming week. Now, I want you to know that on your M15 time frame, if you see your ADR close to your Asian box, or even somewhere there, but if you see an ADR close to your Asian box, just know that on that particular day, the dealer is not going to stop and he will just move down. The dealer is just going to move down. That's exactly what happens. Even if you see your Asian box, your ADR low may be somewhere there, your ADR high is far away there. Just know that your dealer will just do something like this, and then he goes to that ADR which is far away. So an ADR that is close to your Asian box is an indication that the market might sell or buy in that area. It's not going to give you a stop hand. I hope that makes sense. Another question, please.
Is ADR being respected lately, like the past 2-3 weeks, because of the recent volatility? I thought my ADR indicator was wrong because it wasn't being reached. Also had a great question: how does ADR work in indices?
All right. ADR does not work on indices because for now we don't have the ADR for indices. I'm very sorry about this. We don't have the ADR for indices. We don't have the ADR for indices. So it really doesn't work unless if maybe you are talking about the NASDAQ and those other SP500. It does work there because on MT4 we have the software available, but on MT5 we don't have an indicator for an ADR, so it's going to be difficult for you to know if it works or it doesn't work, unless if you know how to calculate it. Maybe you can use it, but for me, ADR for now, I haven't used it on indices. I'll be lying to you. Again, the ADR in the past 2 to 3 weeks, it hasn't been working very well. We noticed it, even Arthur saw it. The ADR hasn't been working very well. However, from this previous week that we are coming from, the ADR has been working very well. For me, on my side, it has been working very well. I've been seeing the pairs respecting the ADR. I remember is it on Thursday or on Wednesday when pairs moved so heavy early in the morning, almost the whole market. The ADR was so good from my broker, 2 a.m. it showed the nice position, but I didn't take the trades because I thought maybe they were going to be stop and in the following day. But I couldn't get the stop ins. But one way or the other, for last week, it was working well. I don't know for this week, we are going to see how it best functions. Maybe what you can do, you can remove your ADR and then reinstall it to have a better working ADR. So guys, now it's 22:45. Let me just explain something right here. On BTMM, we also do have patterns that we follow, just like any other strategy. We have patterns that we follow just like any other strategy. So I'm going to talk about these patterns just a few minutes before we close our meeting. I'm sorry for those who are joining now because we are running out of time, but tomorrow we are going to be together again. I will tell you, maybe we'll circulate the link again if we are on for tomorrow. Make sure you book for your seat, because if you don't, you are going to lose out. Now, on patterns, we have a lot of patterns just like any other strategy, but we have key patterns that we use. A lot of you have heard about this so-called half Batman. A lot of you have heard about this so-called 22 trade. A lot of you have heard about the W. A lot of you have heard about the M. And a lot of you have heard about this famous head and shoulder. I'm not going to talk about this one, the head and shoulder, because everyone knows about the head and shoulder. Everyone knows about this. Now everyone knows about how MMMs trip. Everyone knows about this. Now, I'm going to be frank about these two that are on top there. They are very crucial, and they always happen most of the times in the market. The reason why the market ends up having this, which we call a 22 trade, it is because the dealer would trap just like what he did, and then comes here, and the dealer will decide to go in that direction. Now, he knows there are some people who will enter long right here, and the dealer will then pull back on them, take them out, retest the low again, because he knows that he doesn't have enough orders to continue the market. Remember, I said this market is not moved by a strategy. This market is not moved by indicators. This market is moved by orders. So before you deal with indicators, first understand price action. When I'm saying price action, I'm saying first understand the philosophy behind the candles, behind the market movement, behind the mind of the market makers. Before you deal with indicators, you have to first understand the action of the price in the market. Now, this is exactly what happens. Now, after taking these out, these guys out by going down, everyone believes that when the market gets here, it is going to continue, hit from the bottom, and continue going down. That's what most of us will be believing. But what the market maker does, he doesn't do that. He just grabs orders that are here, and then he shifts the zone. He knows that you would have trapped people already. And also, on our patterns, we have got Ws that have different types of legs. We have got these kind of Ws whereby when the dealer knows that he has trapped, so much volume right here, you will find that he won't come down, because if he comes down, he is going to release some people here and they will escape with little loss. So what the dealer does, he's not going to come back down. He just shifts the zone and goes away. For this one, the dealer knows that he has trapped people, but he feels they are not enough. He extends the zone and takes them out and grabs more orders and go up. So sometimes, even if a setup fails on a smaller time frame, please check a higher time frame and see the demand in which the dealer wants to pursue. Now, the last pattern is the pattern we call the half Batman. I know most of you have heard about this so-called half Batman. Some of you, they mistake it, they don't know. I'm going to show you even from the charts how a half Batman looks like. I'm going to show you from the charts how a half Batman looks like. But in general, what we are saying is a half Batman takes at least 2 sessions to form, or 2 days to form, or several days to form. But in actual fact, we are saying it cannot form in 1 session. It can't form in 1 day. It can't form in 1 session. It has to have a different timing. What we are simply saying is that this is a demarcation. Maybe let's say this is day 1. Let's say this is day 2. So the dealer will rally the market up, collect orders that are beyond here, trap traders long, pull the market down, and consolidate to end the session of the day. You come the following day, and now everybody psychologically knows that we are going to have an M and then go down. So people will be waiting there to escape with weekly loss. Remember, I said when I started this meeting that every time when you press a buy, a sell, always know that there are 1,000 and 10,000 of you doing the same thing in that very same area. So don't say that the market is going against you. It is going against every one of you as a group. Why? Because you are not the only one who is there. There is a whole lot of people there. So everyone will be expecting this move. But guess what? The market maker actually shifts the zone down. He does not go there because he knows if he goes there, he's going to release people. Maybe let me just show you this so that you can comprehend and know what I'm talking about. Here is a 1 hour chart right there. As you can see from this 1 hour chart, this is what we call a half Batman. This is what we call a half Batman. Let me put eyes there. Remember, a Batman is like this. This is our Batman. From the Batman, you know. So this becomes our half Batman. It simply means that we have, from our full Batman, we have removed this. So our half Batman just goes like this. Can you see it? So this is what we are seeing here, whereby the dealer traps people right there, closes the market below, and then he doesn't give a stop hand to release people, and he doesn't give a stop hand because he knows that we are gonna enter there. So the dealer just shifts the zone and goes down. So this is basically the basics of MMM. This is basically the basics of MMM. So I hope you guys enjoyed our first session.